How I turned $2,000 into a 25-year strategy, my investing story. When most people think about investing, they picture this: complex calculations, high stakes, screaming at monitors, and split-second decisions that make or break your bank account. But for the rest of us, for the people who actually want to build wealth and keep their sanity, the reality looks a lot more like this. Hi everyone, welcome back to the channel. Today, I want to do something a little different. I want to take you back 25 years to the start of my investing journey. My path wasn't a straight line to financial freedom. It was a winding road full of trial and error, accidental wins, and some pretty painful losses. It started with a simple employee benefit and evolved into a philosophy I live by today. If you are feeling overwhelmed by the stock market, or you feel like you're late to the party, this video is for you. We're going to cover how I turned an accidental $2,000 investment into a life lesson, the mistakes I made chasing trends, and the 4 pillars that manage my money today so I can sleep at night. Let's dive in. Let's flip the calendar back to the late 1990s and early 2000s. This is when the accidental first win started. My journey began nearly 2.5 decades ago. And I'll be honest with you, I didn't have a grand master plan. I didn't have a degree in finance. I was just working for a Fortune 500 company that happened to offer stock options as a benefit. At the time, I didn't really understand the power of what they were offering, but I participated. Eventually, I left that company. And when I left, I did something that, looking back, was probably the smartest move a beginner could ever make. I did absolutely nothing. I didn't panic sell, I didn't try to trade it for the next hot stock. I just let it sit there. Life went on, and I honestly kind of forgot about it. Tick, 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 tick. 8 years later, I looked at that account. That $2,000 bad investment had grown into $10,000. This was my light bulb moment. Time in the market is greater than timing the market. I realized that I hadn't done any work for that money. I didn't analyze charts, I didn't watch the news. The asset simply grew because the company grew, and more importantly, because I gave it time. It proved the age-old saying that time in the market is more powerful than timing the market. But of course, being young and eager, I didn't just stick to that lesson immediately. I had to go through the wild west of early online brokerage first, the era of drips and commissions. For those of you watching who are used to apps like Robinhood or Webull, you might not remember what it was like to buy stocks back in the day. Today, you press a button and the trade is free. Back then, it was expensive. Brokerages would charge $5, $10, sometimes even $20 per trade. If you only had $100 to invest, you couldn't do it. You'd lose 10% of your money just on the fee to buy, and another 10% when you sold. It was a rigged game against the small investor. So, to bypass this, I turned to something called DRIPs. DRIP equals Dividend Reinvestment Plan. This stands for Dividend Reinvestment Plans. This was my workaround. It allowed me to invest small amounts, often under $100, directly into household names like John Deere, GE, Procter & Gamble, and Home Depot. When these companies paid a dividend, instead of giving me cash, they would automatically buy me more fractions of shares. It was the original snowball effect. My first brokerage, buy and hold. During this time, I joined a platform that was way ahead of its time called buyandhold.com. They were one of the first to offer fractional shares and dollar-based investing. If you've been in the game a long time, you might remember the evolution of these companies. The fintech world was shifting rapidly. My accounts migrated through a carousel of names. Buy and Hold became Zecco, which merged into TradeKing, which eventually was bought by Ally Financial. Don't forget to like and subscribe to support this channel. It was a chaotic time, but it taught me the mechanics of how brokerages worked. Learning the hard way, trends versus truth. I think every investor has to go through a tuition phase. You have to lose some money to learn how to keep it. I was lured in by hot trends. I fell into the trap of thinking I could predict the future. A perfect example was the Solar ETF, ticker symbol TAN. Everyone was talking about green energy. It was the next big thing. So, I bought in. But I bought in at the peak. I chased the hype. This is what happens when you buy a hyped-up ETF or stock. You buy it because it has performed extremely well, not knowing that you are getting in at its peak. As you can see, if you got in at the peak, you would have 78% loss, which still is not recovered even after 10 plus years. That ETF crashed, and honestly, for my entry point, it never fully rebounded to those highs in a way that made sense for the time opportunity cost. I also experimented with picking individual stocks. The thrill of victory and the agony of defeat. Finding a winner feels amazing. It's a dopamine hit, but holding a loser? It's stressful. I found that my positions in individual stocks were too small to make me rich, but volatile enough to make me anxious. I realized I didn't have the time, the desire, or the emotional discipline to be a professional trader. I didn't know exactly when to sell high. I'd watch a stock go up, get greedy, watch it go down, and sell at a loss. I was trying to be a trader, but I was living the life of a busy employee. The two didn't mix. Finding my North Star. About 10 years ago, after the stress of stock picking and the lessons from the solar crash, my strategy shifted. I wanted off the roller coaster. I discovered the philosophy of Jack Bogle and Vanguard. I stopped trying to find the needle in the haystack, and I decided to just buy the haystack. I shifted my focus to DCA, dollar cost averaging, into broad market ETFs. For those who don't know, dollar cost averaging is just a fancy way of saying investing the same amount of money on the same day every single month, regardless of what the market is doing. If the market is high, I buy fewer shares. If the market crashes, I buy more shares on sale. It removes the emotions. Today, my portfolio is built on a foundation of broad index funds and just a select few large-cap companies that I plan to hold forever. Practically speaking, I use Fidelity now for my IRA, Roth, and taxable accounts. This was mostly a carryover from a previous employer's 401k, but I've stuck with them because they make it easy to execute this boring, beautiful strategy. I also use Vanguard for my other taxable accounts where I only purchase Vanguard ETFs. My core investing philosophy. The 4 pillars of my strategy. So, here we are, 25 years later. From a lucky $2,000 stock option to a structured portfolio. My approach has distilled down to 4 main pillars. If you are starting today, I hope these help you skip my mistakes. DCA is king. Regularly investing a set amount removes the stress. I don't check the market every day. I don't care if it's red or green today. The automation does the heavy lifting. Number 2, avoid the hype. I no longer chase the next big thing. If you see it in a trending headline or your Uber driver is giving you stock tips about it, it's usually too late. I learned that the hard way with solar. Number 3, know your role. I am a long-term holder, not a professional trader. I'm not smarter than the algorithms on Wall Street. I prefer assets that historically grow year after year, rather than trying to time a swing trade. And number 4, simplicity over complexity. Broad index funds, like those tracking the S&P 500 or the total market, provide diversification that I could never replicate on my own. It's simple, it's cheap, and it works. Investing doesn't have to be a gamble. It doesn't have to be a second job. It is simply about finding a rhythm that allows you to sleep at night while your wealth grows quietly in the background. My journey took 25 years to go from accidental gains to intentional growth. But you can start that intentional growth today. Investing should be plain and simple. I'd love to hear from you in the comments. What was the first stock or fund you ever bought? Did you hold it or did you panic sell? Let me know down below. If you found value in this story, please hit that like button and subscribe for more plain and simple financial content. Thanks for watching, and I'll see you in the next one.